Okay, everyone, we're going to start bang on time. I'm Giles Barry. I'm the editor of the UK magazine Property Week, and it's great to see quite a lot of you here, some familiar faces for what's a big subject. And I know the organisers of MIPIM are very keen to promote their involvement in logistics. To that end, we've got a really good, strong panel today to discuss trends and evolution in the in the logistics real estate market. Directly to my right, we have Philip Dunn, who's the president of Prologis Europe. In the middle, doesn't quite follow the line here. In the middle, we have Rob Wilkinson, who's chief investment officer of AEW Europe, and at the far end, we have Ronald Hahn, who's managing director of GSE. Just to set the scene for you, I'm going to ask them each to introduce themselves and tell us a bit more about them and their organisations. Then I'm going to pose some questions to them myself, and we'd eventually love to come to your own questions. Please store up as many as you can. So, Philip, if I could ask you to introduce yourself first.
Sure. Good morning. So Philip Dunn, I've been with Prologis for just over 3 years, running the European business of Prologis. Globally, post the merger with AMB last year, we've got just over 55 million square meters owned and under management. About 50% of that is owned through co-investment vehicles and funds, and the other 50% is wholly owned on our balance sheet. In Europe, we've got 13.7 million square meters owned and under management. We operate the business in Europe partially through our balance sheet, which we use to develop new buildings, and then through takeout vehicles vis-a-vis funds and joint ventures, of which we've today got 4. We've got the public fund PEPR, which we continue to manage as a public fund, PEP2, another pan-European fund. Each of these funds approximately 3 billion of value under management. Then we've got a targeted logistics fund, which is about 1 billion, and then a joint venture with Allianz, which is just getting off the ground.
Okay, so big stuff. And the merger with AMB that Prologis carried out, I think they completed it last June. I'm going to go back and talk to Philip about that a little bit later as part of our Q&A session. Rob, over to you.
Thank you, Charles. Morning to you all. I'm Rob Wilkinson, the Chief Investment Officer of AEW Europe. We are a fairly significant player in the logistics market, but slightly differently, we're also somewhat more plural. So as a generalist fund manager, we have about 18.5 billion euros of real estate assets under management, of which a little over 10% is in logistics space, so it's fairly meaningful. About 2 billion euros of logistics assets across Europe, a little over 2.5 million square meters. We also were there pretty much at the beginning of the investment market for logistics, starting our logistics branded platform in 1999. So we manage logistics funds, specialist funds, for around 2 billion euros.
Okay, and with a slightly different perspective, Ronald, please.
Good morning. Ronald Hahn. Yes, I think I do actually have quite an interesting perspective because I worked for GSE, my current employer, up until 1998. Then I joined Prologis, and for 13 years I ran the Southern European region for Prologis. And then we talked about the AMB merger. I was one of the victims. I returned to GSE this autumn. GSE is primarily a construction company, but we get much more involved in the engineering, in the conceptualization of buildings than a regular general contractor. We build, incidentally, for both Prologis and AEW. We do about €500 million of construction per annum. Up and down, obviously. Last year was not too bad, but there have been better years. That equates to about 1 million square meters of space, but space including much higher value space, obviously, than logistics. We do research and development offices and so on. Very happy to be back where I was 13 years ago, and during the course of the conversation, perhaps to make some comments about what has changed in those 13 years and what hasn't.
Okay, and it'd be interesting also to hear Rob. I'd forgotten that AEW was in there so early. Now, everyone at MIPIM, particularly early on the first day, always wants to know what's the mood, what are the conditions. The first question to the panelists is going to be, how do they foresee the investment market for logistics in 2012? So let's start with you, Philip.
I think 2012 is going to be more of the same. If we just think about overall volumes in 2010, total transaction volumes are about 8.4 billion. And then 2011, I think it worked out at about 8.8, 8.9. So pretty consistent on an annual basis, but quarterly it was very, very choppy. Deals clearly taking a long time to do. Investors are, like us, and many people in this room, very discerning, very picky. We want to know exactly what we're getting. Getting at value and value opportunity is hard. It's hard work. It's back to basics. And I think it's going to be, frankly, more of the same. Now, one of the interesting trends we've all seen through 2012 is really the same characters turning up to bid, particularly on portfolios. We've experienced that ourselves. The private equity groups have a significant intent to build and create a platform, as well as our sort of traditional competitors, the likes of Goodman and others, and Segro, all looking to continue to build pan-European platforms, and that requires some transaction activity to keep the business moving. So more of the same. We, Prologis, strategically, we're very focused on just changing the shape of our portfolio a little bit. On an annual basis, we anticipate churning somewhere between 3 and 5% of the portfolio. And that is just working it through in terms of location and age and exposure to customers right across on a pan-European basis. So, our platform is going to trade, and I think many others will continue to trade, but the market is thin. Clearly, debt continues to be a challenge. We'd all love to buy good quality buildings with 2 and 3 year lease terms, but they're selling too expensive. So we're all holding on to them. So there's really that uncertainty. There are buyers out there. There is capital out there. Not enough debt to, I think, see volumes spike in any shape or form. And I think it'll continue to be choppy from quarter to quarter, but about the same as what we saw last year.
One thing we saw back in Britain in the last, just in the days before Christmas, actually, was a huge flurry of activity. I think £1 billion of industrial and distribution property was transacted just in a week before Christmas, which was fantastic. Blackstone were at the forefront of that, weren't they, Philip? I think you did a deal with them. Yeah. Well, why are people like that coming into the market at the moment, do you think?
Well, I think Blackstone see the opportunity, and they've been very successful raising capital that wants exposure to logistics in a big way. They'd love to, I guess, do a big pan-European deal, but it's probably too complicated to get away. What
is it about logistics? I mean, they could put their money into offices, shopping centres. What is it about logistics at the moment?
Well, I think it's logistics. Nothing is recession-proof, but logistics has proven to be fairly robust. Once we got over the swell of oversupply in the markets, the reality is the demand drivers are fairly unique in that even in a recessionary environment, we've seen the opportunity to significantly move our portfolio forward in terms of leasing and occupancy. And so in a benign environment, consolidation, reconfiguration, moving from old buildings to new buildings, or more modern buildings, more efficient buildings, those drivers continue to push demand for product that's in the right locations for those customers. And so pretty robust from a take-up perspective. And also, historically has delivered overall higher returns than offices and retail. Yeah. For Blackstone and others, if you can buy a good portfolio and put some reasonable modest leverage on it, it's probably a good bet.
Okay. Rob, how do you see the investment market for logistics in 2012?
I think I would agree generally with what Philip said. I think one of the interesting things about the logistics space, perhaps relative to retail and office, is if you do go back over the last 10 years or so, back in the early 2000s, late 90s, it was very much an emerging asset class, so it wasn't established as an institutional asset class within real estate. That has evolved over that period, and I think that has probably facilitated some attractive returns for logistics over that time period. A bit like big box retail did in the 80s, same sort of phenomenon as that asset class has become more established. So we think it's now in line as an asset class in terms of relative pricing versus office and retail. More specifically, and looking forward, we're pretty positive about logistics over at least the medium term. I think we're a little bit nervous about any asset class in the short term. We shouldn't forget what 2011 was like. Where I'd slightly differ is more of the same. I hope that we don't quite have the same as 2011. But 2011 was a year of two halves, of course. The first half, which was actually quite a benign environment, where pricing was pretty stable, investor interest was relatively strong, and I think logistics was attractive given its yield profile, etc., relative to other asset classes, and particularly in the core prime sector. And then, of course, the summer happened, and the world changed, or the world looked like it might end at some point during the latter parts of 2011. So we come off of that backdrop, and then our perspective is going forward. We expect things to stabilize somewhat. There might be some short-term softening on prices, but not for terribly long. And then as trade flows and hopefully growth comes back eventually, that will then start to enhance the logistics positioning, and with the prospect for some rental growth to come through. But fundamentally, we think it's an attractive asset class because of its yield profile, lack of volatility, as Philip was saying before, and potentially medium and long term, as the whole structure of trade and retail across the globe is changing. We think logistics is an asset class that will benefit from that.
And maybe, Jazz, there's just relative to that demand piece, and the summer crisis. We watched our own stock price get significantly discounted because of our exposure to Europe. So that made me feel really good. And we did worry about what that was going to mean for the portfolio in terms of just managing occupancies. We had pretty aggressive targets to improve occupancies overall. And the direct opposite happened of what you'd expect. Occupancies went up. We didn't lose one deal. There was no customer pull out of a deal because of what was occurring during the course of the summer. So, demand does work very, very different to what we see in the broader macroeconomic environment. Now, it's not immune to it. Clearly, we're not seeing massive growth in demand for new product, but with what you have on the ground, it's definitely a very solid investment class.
Okay. Well, let's move on to the development market, because obviously we have to create new product, if you like, for this market, which is looking quite healthy. Ranald, you're directly involved with the development side. What's the mood at the moment in your world?
Well, as I said, my perspective is somewhat different in that we don't own any assets, or at least we try not to. Occasionally we take a mortgage in lieu of payment, but that's to be avoided if possible. So asset-free, we work with developers. We ourselves are not really a developer. We're certainly not an investor. But what I see is a return to simplicity, a return to real estate fundamentals. Leverage is less available and is no longer able to cover up all the ills and blights that you might have on a development. What I find very curious is that after 13 years' absence, we're almost directly back to the values that prevailed in 1998. I just jotted a few down. A 40 euro rent is equivalent to 260 francs, which is the sort of rent level that I remember when I was last at GSE. I think it got up to about 300 francs, and then we changed over to euros. Cap rates today, let's say, again, for principally for France, but perhaps for Italy too, 7.5 to 8. Again, that's a little bit sharper than where we were in 1998, but by 2000, we'd got to that, if I remember rightly. Construction, that's an interesting one. I remember we used to build a basic warehouse for 1,600 francs. Today it's more like 300 euros. They don't quite equate, but the buildings themselves, through administration, have become a bit more complicated, more fire break walls, more insulation. If you strip out that overvalue of 15%, you get right back to the 1,600 French franc per square meter construction cost.
Again, in 1998, unless you had a 9-year lease, there was no way anyone was going to build for you, and that's exactly where we're back to today. Investors were very selective about locations. If it wasn't, let's say, the north of France, Le Havre or Lille, Paris, Lyon, Marseille, the business was not going to result. And that's exactly where we're back to today, after a peregrination all across the country where anything would do. We're back to the same strategic locations. No spec build today. Nobody's building spec at all, I think. And I think the other thing that I noticed is that we went through many years of convergence, where basically all buildings, all tenants, all leases, and all geographies were worth the same cap rate. Clearly, we've turned away from that, thank God. We actually look at the real estate, we look at the market, we look at the prospects for growth, we look at the ability of the tenant to pay his rent for his committed period. And that has created, obviously, enormous deconvergence, and thank God. So I think a simpler world, a healthier world, and back to fundamentals.
Okay. Philip, back to you. Development. I mean, there is no spec development, or are you doing anything anywhere in Europe?
I'm going to correct Ronald. He was the first out of the blocks before he left in January 2011. Well, we presented as a spec. It was a part spec, part built to suit. And we've done one or two more. We've done one more in Paris and we've done one more in Hamburg. But that's it. And that is simply in sub-markets where either there is absolutely no new supply of modern product, or in the case of Moissy, just the unique aspects of the park made us feel good about going. In our plan for 2012, we've planned for about 20% speculative of our total plan of roughly 300 to 400 million euros of development starts. That could be 100 million euros. It could be 500 million euros. That's the development market at the moment. It's built to suits. They take a long time to bring through. It takes a long time for the customer to commit. And if anything, on the development side, that's the part that is starting to feel a little bit choppy. I think companies and boards are starting to slightly tweak their decision-making criteria, perhaps recycling more cash rather than making new commitments to invest. And so we've got a pretty strong pipeline, but as I say, it takes anything from 6 to 12 months to bring a deal through. We've put a little bit of speculative into that number, really just so that investment committee doesn't hammer us if we come through with an opportunity. But we won't do it unless it makes absolutely perfect sense. That said, overall new start volumes have increased materially through 2011. But a big chunk of that is actually Amazon, who are a particular driver, big buildings, not necessarily always in core locations, but they have driven a significant spike in overall development starts. It's not necessarily always the type of product that any or most of us would want to invest in long term.
That's fascinating. One occupier, I know they're big in the UK. They're equally influential across Europe, are they?
Last year it was particularly in Germany. They are very focused on the UK, Germany, France, and continue to have a very aggressive expansion program. And it's not just Amazon. There are other e-commerce businesses. The existing major retailers are also boosting their e-commerce offerings, and that's driving demand for new space. And
rents, actually let's ask Rob, but where do you see rents going in the next, this year and the next couple of years then?
I think we don't expect a lot of growth coming through in the short term. I think there have been some big drivers to demand, but it's pretty competitively priced demand as well. The weight that some of those retailers and or 3PL providers have in negotiation is pretty strong. So at that level, it's good demand in square meters, but it's competitive demand as well. So we don't see the drivers for short-term rental growth particularly, but we'd probably argue the same for most asset classes as well right now. So I think it's a market that generally is quite muted for 2012, but thereafter we would expect some growth to come back as, again, particularly on the office side by comparison with logistics as well. Funding is an issue. Funding is particularly an issue for the developers, and that is going to put a strain on supply. I can remember, it's probably going back 3 years, probably at the peak of the first wave of the crisis, in my former life, being in an organisation similar to Philips. For the first time, I think in my career, I saw a situation where developers were actually almost turning occupiers away because there simply wasn't funding. That situation has improved, but it's still a constraint. So I think there can be a bit of a supply constraint that will help rental growth in the medium term.
Okay, interesting. Now, people always at MIPIM again want to know about hot spots and what I'd call not spots. If I give you each 3 places to invest in logistics in Europe in the next 1 to 3 years, what would they be? Let's start with Ranald.
Fortunately, I don't have to invest.
Well,
but
you can say what you like then.
We follow the activity, which is not quite the same as the right places to.
If I had to ask you, where do you think is the most promising?
Clearly, Poland, France, Germany.
And where about any particular locations within these places, within each?
Again, as an investor, if I'm wearing an investment cap, I could go back to what I said a moment ago, and Philip repeated about France, that you're going to be in strategic locations only, whereas a few years ago anywhere would do. Same for Poland, principally Silesia, Warsaw. Germany, I think there are considered to be 5 or 6 main markets where you'd want to be, and some to avoid. But as I said, we follow activity, and perhaps I can make a comment a little bit later. Activity and investment aren't quite the same thing. There are a lot of people that are now owner-occupiers. They choose to be. They get the building that they want in the location that they want on a commercial mortgage or bank finance or using own capital. We used to think, again, when I was in GSE the first time round, that about 50% of our activity was for owner-occupiers, 50% for developers, investors. During the time that I was away, that swung to something like 60% for investor developers. It's now back at 50% or less. There's a lot of owner occupation going on. Finance is available, mortgage finance is available, particularly to the stronger industrial company. And again, that's a lot of our activity at the moment.
Okay, Rob, where would you put your money if your life depended on it? Your top 3 locations for logistics in Europe?
Yeah, I mean, I think a similar theme to what Ranald was saying. It's slightly different to office and retail, where you can actually spot cities, as it were. In terms of hotspots, I think it's more about the demand drivers from the occupier perspective, and that's a lot, I think, to do with the theme we've talked about, which is the internet retail phenomenon, and therefore people looking for perhaps slightly more metro locations rather than just build-to-suits close to industrial areas, etc. So I think metro, if you can get close to metro areas driven by that consumer demand, then we see that as attractive. In terms of countries, we'd certainly agree France, Germany. Poland we also agree is attractive from an overall macro growth perspective. We'd also add probably Southeast UK into that as well on top. So those would be the sort of 3/4. But it's less about particular sort of markets, and it's more about where those demand drivers are coming across the European network.
Okay, Philip, locations?
It's largely going to be more of the same, but it also very much depends on what your investor wants and what they want exposure to. You can invest in London at a 5.5 cap. You can invest in France and Germany at, let's say, a real prime, so we're 6.5 and 7, hazard a guess, depending on which markets at. And in Poland, you can probably get some pretty decent kit at somewhere around an 8. So it really does depend on where your investor wants to be. I mean, if I guess you could buy in Russia at an 11. We're not going to go there. None of our investors want us to go there. It is really exposure to the risk spectrum that will determine where you want to put your money. A big bet for me is Barcelona. I mean, if I had to put 100% of my own cash in tomorrow, I'd love to get something in Barcelona at the right price. Getting it at the right price is not easy, but I think there are some selective opportunities out there. And Poland will definitely, I think, give a pop. I mean, you think modern distribution facilities in Poland is about 6 million square meters of total stock, and we've got a third of it, which will tell you how crazy we went in the good days. But it's a very, very thin market for an economy that's continued to grow very strong as a 40 million population, pretty well educated, very well educated, and very attractive country to invest in. So I think, whilst it may not come back very quick, I think there's a lot more to go in Poland, and so you could bet that over time, there's going to be a convergence between Poland and Western Europe, I think, in particular. And whilst the Poland's entry into the euro, if it stays alive, is probably a long way away, that will be the day that I think the whole thing will turn. So if you take a long-term view, Poland's a good place to be.
I mean, I'm very, very interested, coming from our non-Eurozone perspective back in the UK. We've merited Britain there. One little mention, Southeast UK, whereas the Eurozone is very, very challenged economically at the moment. It doesn't seem to bother you, though, Rob.
I think the Eurozone certainly has issues around the sovereign debt and sort of concerns that are coming off of that. We expect that whilst the euro may well remain, there will be different parts of the euro. We see certain countries performing better within that than others, France, Germany notably, probably Poland, Czech Republic potentially. We see other markets as being much more challenging, for example, Spain and Italy. I'd agree with Philip, it would be nice to be able to do something in Spain. But quite frankly, the land prices there are just extraordinary. They were extraordinary at the peak, and they, for some reason, remain that today. Possibly because a lot of it was equity funded, so it doesn't need to move. But when it does move, I would agree that would be a very interesting market to look at. In terms of UK versus euro, from an investor perspective, obviously the big issue is currency from our perspective, and so we would expect those pools of capital to be separate. And that's a trend we see staying. So I think you've got different investors looking at different markets, to be honest, as well.
Okay, you've got yourself off the hook. My next question: which regions would you avoid as investment or development opportunities? I think you said Spain and Italy, largely. Ranald, what do you think?
We clearly wouldn't go to Greece and probably not Portugal, but we are building, even as we speak, in Spain, Romania, Hungary, Morocco. Countries, again, economies where the investors would have to be very brave to wish to go. There is activity, people need buildings, and they're able to fund them one way or another. I agree entirely with what was said about Spain. It's got to be an interesting market, but there has to be a correction, a major correction. We're building for people that have owned land historically, and therefore they don't have the land asset problem. But anyone going into Spain today and being made to pay 250 euros a square metre for logistics land is either insane or knows something that nobody else does.
Okay. Philip, where are you steering clear of? Because you were big in Russia at one point, or looking at Russia, weren't you? Other big parts of Central and Eastern Europe.
Yeah, I mean, we got most of the markets in Central Europe covered. Russia's a step too far for us at this point. We definitely need to see, a significant improvement in basic levels of transparency to be able to invest, particularly as a developer. You could probably eke it out as an investor if you're prepared to take the risk and get the premium for it. But one step too far for us. It's not that it's not an attractive location, particularly Moscow. It's just too much like hard work right now. So other markets where we've all sort of retrenched a little bit. Germany is a challenging market. It's very, very fragmented. You can get first-class buildings popping up in the middle of nowhere. And for us today, they're buildings that we're going to stay away from. We'd happily deliver them, but any opportunity we typically get, we can't find somebody to take them out, and we don't want to develop them for our own funds. So I think being very selective in Germany is going to be really, really important. That will win the day. And all the same, I mean, Greece, Portugal, way off the radar screen. And we do have a park in Romania, but we don't feel like there's a whole lot of scale that we can get there over the next 3 to 5 years, so probably wouldn't bother with that one either.
Okay. Now, moving on to the future, if you like. What wider business trends do you see affecting demand for logistics property? Back with you, Philip. I think the internet is the big one, isn't it, at the moment?
Well, the internet is definitely interesting. And
are we going to see distribution sheds or logistics sheds cutting out shops, do you think? Much more people direct direct deliveries to home?
I don't think so. I think it's just a rebalancing. But what's perhaps more interesting, and I can't predict, but I don't predict overall that there's the doom of the shop and that we're all going to shop from our sofa. But retail is evolving and changing clearly, and that is an important demand driver. What we're seeing from the big retailers is massive consolidation. So consolidating from multiple smaller, perhaps in some cases obsolete warehouses into much bigger, more modern, high-tech facilities. An example of that, we handed over a building last year to Tesco. It's a just under 80,000 square meter building where they were consolidating something like 20 to 30 smaller facilities into one big one, and it's rail connected and is completely changing the way they distribute their stores and directly to their customers, where they service both. So your e-commerce is important, but it's driving demand for massive big facilities, and rather than a wholesale change. The other key thing is the outsourcing of logistics continues to evolve. We haven't seen it grow as much as we thought it would, but we've seen fierce competition amongst all of the third-party logistics providers, DHL and UPS and CEVA and Renus and so on. And that's creating churn. So every time a customer changes a contract from one to the other, typically it usually means a change of building from one to another. So that continues. The reconfiguration continues. As I said recently to some of our investors, supply chain management is a profession. It's not going away. And as long as it's a profession, there's people out there finding better ways to do it, more economical ways to do it, and more efficient ways to get goods to customers. One thing we heard from a manufacturing customer recently, which was quite an interesting trend, which is the retailers saying, you need to deliver direct to store rather than delivering to our warehouses and we'll direct. So really pushing the supply chain back up. But again, it's good for the industry. It creates churn and demand.
Okay. Rob, what do you see as the wider trends affecting this sector?
Well, I think, first of all, on the retail side, I think you ask yourself last time you went into an Apple store whether it was busy or not. I don't think the high street is going to die at all. I agree with Philip. I think there's a rebalancing. It was a much sort of talked about phenomenon, probably going back 8 to 10 years ago. Suddenly the internet was going to destroy the high street. It didn't for a long time. But I do think that the consumer trend has now very much shifted towards that. So that will just increase, probably still relatively exponentially as well. But I don't see it as being the death of the high street for various reasons. I mean, look at fashion, for example. There is just simply no way that can't be on the high street. So I think it's a change, and the retail format should and will always evolve and change. So I think that's the first thing. In terms of impact on logistics, clearly, though, the sort of parcel-based businesses, the online retailers are where a lot of the demand is going to be focused going forward, undoubtedly. The other phenomenon, I mean, I don't think there's another sector quite like it for consolidation, whether within the actual operators themselves or within us as investors or within us as developers. It is extraordinary, the level of M&A activity, and it's still going on as we speak. That's a wholesale structural change to the supply chain, and I think that is going to continue to have its impact going forward, and I think it's going to continue therefore with demand for grade A, for new build, for larger units, which then also creates a question on the sort of the investment side. From our perspective, if you look at the 100,000 square meter Amazon shed, and I remember when they first started coming through probably 4 years ago now, they started to wanted to build those. Actually, on our side of the equation, the question was, well, actually, is there an investment market for an asset, one lot size, for that sort of thing? I think that's now starting to prove itself, and that will continue. So I think retail-based and parcel-based is going to drive the demand side, and I think over the longer term we are going to continue that trend towards larger grade A new build facilities.
Yeah, it's interesting. Philip, go on. On the merger front, even a sort of sketch of the logistics world, both its developers and its major tenants, the third-party logistics group, would look completely different even 5 years ago, wouldn't it? So much activity. But Philip, you were saying?
Yeah, the other driver, and Ranald's probably more equipped to deal with this one. But sustainability is driving change, and for the customer, at the end of the day, it's all about cost. And we've produced some jazzy statistics that a brand new facility in the UK is on average 65-70% more efficient from an energy perspective than an equivalent building of 10 years of age. And so, interesting, customers won't pay for it, but it does differentiate and it does drive demand. I mean, it's a real no-brainer for healthy companies to look to get after those efficiencies and reduce their cost base and increase the bottom line.
Ranald, trends, changes, what do you think?
Well, just picking up on Philip's point there, it is quite an interesting one. Back in the good days, a building was usually commissioned, leased or bought by the head of supply chain or head of real estate, somebody who knew what he was doing, knew that there was a relationship between quality and cost, and that you don't only look at cost necessarily. In the last 3 to 4 years, this is obviously a generalization, but we've seen the buying people, the buying division of big companies, take the ultimate real estate decisions based pretty much uniquely on cost or face rent, whatever it might be. So longer term considerations such as what is actually my running cost of this building, what is my heating cost, my electrical cost tends to get overlooked. People look at the basic upfront cost, rent or price, creating difficulties for people such as ourselves. Margins are thin and getting thinner, but also frequently creating bad buildings that won't stand the test of time. I'd like to think that is changing back. There's no evidence of it, but it should. People should look for long-term quality rather than just upfront cost.
Okay. Now, we talked about mergers and consolidation just now. The A&B merger with Prologis last year created, by floor area certainly, the world's biggest property company. Philip, can you just tell me what's been going on since then and how the new organisation will be different, what it'll be doing, the bigger Prologis, if you like? Sure.
There's numerous strategic reasons for having done the merger, but one of the major ones is if you step back and look at the origins of the two companies. Prologis has grown up largely as a developer and entered into the fund management business as a way to fuel growth for the business, whereas A&B grew up as an investment manager and got into development because it had to, because it was losing ground. But was very much a first-class institutional investment manager. Prologis learning to be one. I would say A&B not as good at development, and I think Hamid and Walt would say the same. Whereas Prologis is really, really good at development. And so when you put the two together, you do get the best of both worlds on a piece of paper. We clearly went through all of the challenges one has to in putting two companies together, where you have overlapping roles and jobs. That was less so in Europe. We announced at the end of January last year. We closed in June. And I would say, we had all of our senior people together in January for our annual kickoff, and it really felt like what merger. So the teams are very well integrated. We came out of the blocks as a company very early on with a clear strategy for the combined business, and so we've all been able to rally around that and get on with executing it. And then there's some things that drag. We've got to integrate two sets of systems and all that kind of stuff, and we're working through that through the course of this year with a significant investment in single global platforms for both real estate as well as finance and other things like customer relationship management tools. So what has it meant? It meant creating truly, I think, a world-class leading company in the real estate industry, not just industrial. And the ambition of the company is to be one of the top 3 balance sheets in the REIT sector. And that's what we're very focused on through improving over time the shape of the portfolio, reducing our leverage to something like a run rate of about 30%, and continuing to use the capital that we recycle to both do these two things, pay down debt and reinvest in new development opportunities and new acquisition opportunities where they make sense. On the development side, most of the land came into the merged company from Prologis. But we have just under 1,500 hectares of land, and I'd say 2/3 of that is first class, really well located land in process, some of it ready to go for logistics. So we've created a strength that frankly helped us through the course of the summer, whilst we got pretty heavily discounted through the course of the summer and the back end of last year for exposure to Europe. It allowed us to be much stronger as a company and less reactionary to how the markets were choosing to price us. And coming out into this year, the stock price has largely recovered to NAV, in fact trading, getting close to a premium. And that strength will allow us to hopefully get first mover advantage on many of the opportunities that are in front of us. So within a relatively short period of time, we've turned from doing a lot of navel gazing and fixing, frankly on both sides, to being out in the front foot and able to get after the market and the opportunity when it presents itself. Why 30% leverage? That's Hamid's big goal, because next time the market chooses to discount us, we'll just go out and buy our own stock. And that's the best value thing we could do. But we're about 45% leveraged, it's a little bit tough. You don't want to borrow money to do something like that. So strengthen the balance sheet so that we can take opportunity wherever it presents itself.
Yeah, I mean, I would say 30% also because Prologis got horrendously over-leveraged before, didn't it? And, perhaps a bit of a lesson.
It got a little bit out over its skis. I think over the period of a couple of months, and Randall will certainly remember it very well, it was just before I joined. I was watching from the outside where the leverage went from about 60% to near on 100% as the market decided to disintegrate. And one of the challenge for Prologis was it had built a huge development pipeline and bought a lot of land, and all of it was borrowed or paid for by debt. And so it did get overexposed. Prologis had to do a lot of things in managing through that, selling assets and recycling that capital and paying down debt. But the combination of the merger has really meant we can put all those things behind us, and both companies truly are a global platform. We're in roughly our platform and locations represent about 80% of global GDP. So I like to think of it, we're in pretty much 80% of the locations that our customers need us to be in. And so that's a very, very powerful thing. The old Prologis sold out of China, significantly reduced its platform in Japan, exited Brazil, the Middle East, and India. AMB had created new fund ventures in China. We're very strong in Japan and had a platform by way of joint venture and a fund in Brazil. So we've been able to respond to what many of our customers were telling us in the downturn, which is, we need you to be in these emerging markets for us.
Rob, you wanted to add something?
Yeah, just coming back to the M&A phenomenon. One of the things about logistics, obviously, which I think is interesting, is it's probably the real estate asset class that is most closely entwined with the occupier's operational business. Some people often talk about shopping centre synergies, but I think logistics is probably the only space where that's truly the case. So it's a couple of interesting things. The continuing M&A and consolidation in the operator side of the business is inevitably going to cause a phenomenon. It's a volume business at the end of the day. And so, as developers and investors, we need to respond to that. And I think that's why we will continue to see a trend of emergence of leaders within, and probably a smaller number than today, of leaders on the investing and the developing side going forward. So I think that it's that relationship between occupier and an investor developer which is so much stronger, which is going to impact that. One of the other things that our research team did, which was interesting to note as well, is we've looked at the relationship between logistics yields and also the pricing of the quoted logistics operators. And the correlation between the two, perhaps it's not that surprising, but compared to other sectors, there's no correlation, office occupiers versus office pricing. But the correlation is almost 1. It's 0.9 correlation. So, what's happening to the operators, the listed operators, the DHLs in the stock markets is actually quite a good barometer for how logistics assets are pricing as well, which is interesting. It just goes to show that relationship again.
Interesting. Right. Let's see what questions the audience has. Ask away, anything you like. Who's going to be first? There's always a first. Come on, there will be one. Who wants to ask a question? Got the top brains in logistics in Europe here. Here we are. Ah, familiar face.
Yeah. Hi there, Roger Mann. Just really picking up something that Ranald said earlier on. He talked about procurement departments now acquiring or now instructing to buy and organise buildings, new buildings. Inevitable result of reduced margins for the developers. Well, not worry too much about that. But sustainability issue was interesting point because you basically, I think you said, we're therefore putting up inferior buildings or buildings that are not sustainable. I'm sure that's a generalisation, but I do understand your point, and I have seen that. What do we do about it?
Well, I'm afraid for the time being we've lost the argument that you should look at the long-term running cost of a building, which was one of your points a year ago, I remember. It's not going to happen, I guess, when everyone's margins are thin, when procurement departments run the show, and when a building is seen as a cost and not as a potential source of future profits.
The only counter I'd put to that, and Ranald is, feeling in particular at the coalface in terms of how things are having to price to make any sense to go in and even build the thing. One of the things we generally try to do is avoid that competition, and so there's a lot of nonsense in the press. Everybody likes to get their press release out. We're building this, we're developing that, and we're great and we're wonderful. And I have to be careful not to completely ignore it. We have to have an appropriate competitive response, which is to make sure that I've got a choice on everything that's out there. But there's just stuff out there where we won't even bid because we know it's going to be beaten into the ground and everybody's a loser. The reality is most of what we will develop is product that we want to own long term, and we want to have that customer relationship long term, as you know, Roger. And we're the losers at the end of the day if we compromise. Now, you can't beat market forces, but I would say when you see the likes of Prologis or AEW or any other, Goodman standing back, actually Goodman are the ones that are driving it pretty hard at the moment, but if you see big credible operators standing back as a customer, I would say, take note. You may not be getting what you think you're getting.
I think from the investor perspective, sustainability, or perhaps more significantly, energy efficiency, particularly in the logistics space, is a fairly key characteristic. And Ranald was saying that from his side of the telescope, or end of the telescope, the sort of running costs are not an issue. Obviously, from our side, we see the other end of that telescope at the end of the lease or on break positions, and those issues do count at that point when they're doing the comparison, because they've lived in the asset and they know what those costs are, or they're more focused on them. So I think efficiency, energy efficiency and sustainability are certainly more important issues than they were 3 or 4 years ago. Same phenomenon within the office space. It's just as much a feature there. But I agree with Philip. Generally, they won't pay for it, but they're less likely to leave your building or more likely to come to it if it is. And so it affects pricing and it affects returns. So it's here and now, and it's something that we have to deal with.
Okay, who's got another question? Who's going to be next? Yes, one over here.
Hello, I come from Finland, and I just want to ask, would you like to comment the opportunities in Nordics?
Okay, let's ask Philip first of all.
Well, I'll have a go. We've got a pretty decent platform. I'm looking at Joseph here, who runs Northern Europe's bet. 600,000 square meters, roughly. And it's pretty much concentrated in Gothenburg, the middle of Sweden, the Jönköping, Norrköping areas up to Stockholm. And Alan Levine, who runs our business up there, would love to do Norway, probably Oslo, and dip his toe in Finland. We just haven't had the courage yet to go in. It's not to say we won't. The Nordics has proved to be very, very robust markets through the downturn, and so it's of interest, but we're just not there yet.
Are there any particular development challenges around logistics property, perhaps around the climate or anything like that, or is it it's everything you can overcome?
I think you can largely overcome. I mean, Sweden, you have to blow mountains out to get the ground to, and we can build in Poland in the snow as long as we get the ground in before the winter. So I think there are things that can be overcome.
Rob?
I think we think, from a macro perspective, those countries could be interesting. It's true, though, that today we don't have any exposure to the Nordics. There's also the currency issue just to take into account. But I think we are interested in the market, so something for us to focus on in the future. But right now, we're not currently present.
Okay. Let's see who else wants to ask a... sorry, Philip, yeah.
Can I maybe just help with that question? One of the challenges in our sector is critical mass, as Rob was saying. You need to know over a reasonable period of time that you can create sufficient critical mass. And that's very much, again, occupier-led as well. For us to be in any market with 1 or 2 buildings, 100,000 square meters, is a lot of management effort, and we do everything in-house for very little return at the end of the day. So unless we can get into a market and create something reasonably substantial, it's hard for us to get our heads around it right now.
Okay, I think we had another question here.
Yes, hello. Ports are getting bigger, vessels are getting bigger. So will this have some influence on the logistics too, this maritime aspect?
Let's ask Ranald first in terms of scale of buildings. What do you think?
I think what we build is probably quite a good proxy for what the market is doing. We in France are about 30%, in other markets we're about 20% of the market share. I think what we're seeing at the moment actually is a sort of polarization. Big buildings are getting bigger. There are some very big buildings, as you know, we've mentioned Amazon, but there are some other very big buildings currently looking to find solutions in the marketplace today. But generally, I would say our building size, our mean size, is probably getting smaller. That may be a result of recession and downscaling of requirements. But we used to say that a typical building, typical warehouse building, pretty much anywhere in Europe, was 30 to 40,000 square meters. The more typical is probably now 20, with the odd aberration at 100,000 square meters. But I'm not sure that has anything at all to do with maritime trade. Probably not.
No, I think if you want to pick a trend out of it, it simply drives growth in the movement of goods, and movement of goods drives growth in demand for space. But I don't think it particularly drives the nature of the space that customers need to occupy.
Rob, do you want to add anything?
I'd agree. I think it's driven by the demand side from the retailers for the big box demand. So no, I think the maritime doesn't particularly directly influence that.
Okay. Who wants to ask time for one more question? Who wants to ask the last one? Just over here, thank you. Microphone's on its way.
Hello, I come from Greece. I've heard that there is no interest about investing in the south of Europe, also in Italy, in Portugal. And I would like to ask whether you find that there are still some opportunities there. The area for logistics, it's still a prime area. There might be distressed assets for tourism and leisure. And therefore, I would like to understand more why there is no interest at all.
I'm going to pass that one straight over to Ranald, because he's one of the most seasoned experts in investing in Greece.
If my earlier observation was said with feeling, it was because a few years ago, 2008, we were actually on the verge, when I was at Prologis, of making a €200 million investment in Greece. We escaped by the skin of our teeth, and I'm eternally grateful. No, as a construction company, we will go wherever there are credible customers. The problem is that if investors don't like the longer-term, medium and long-term view of a country, they won't go there, which means that there isn't going to be a lease solution, and the lack of a lease solution normally crimps the growth in the sector.
Yeah, it is simply that. And you see it, it's not just Greece. And you saw what happened with Europe. People point the fingers at Greece, but you saw what happened in Europe during the summer. The markets got really nervous about what was going on in Europe. It's uncertainty scares the crap out of everybody, especially what we've been through over the last 3 odd years. And so it's just going to take time. It's not to suggest for a second that there isn't an opportunity for logistics in Greece, but as long as it makes us nervous to invest, we're never going to get the kind of returns or premium that would justify stepping in now. So it needs a little bit more time.
Rob?
Yeah, I was just going to add as well the sort of geopolitical aspect as well, the risk there, which adds another layer. So it's not simply a macro story that is challenging, because that of itself is not a reason not to invest. It can, in fact, as you quite rightly point out, it can lead to very interesting opportunities if they're correctly priced. If you add in the layer of potential geopolitical risk, change to the fiscal regime, which Greece has also undergone from a real estate perspective recently, that adds a whole different layer of uncertainty that investors will just step away from, I think, as well.
Can I just turn the tables on the lady who asked the question? We're all talking about Greece as if, we're the sort of angry parents, if you like. What are the prospects for Greece at the moment going forward? How does it feel to be there, and what do you see the future is?
I don't think that that anyone has the answer, but it seems that there are opportunities. It seems that there can be massive products, the Elliniko property, and it seems that there might be also political wish to attract foreign investor. So, here the gentlemen know the real estate market better than me. So, and they represent a number of investors. So I would expect that the ratio between opportunity and risk is something that it could be manageable, and it could be, computed or factored in with respect to future investments.
I agree with all of the above. The only thing, you need to look at Ireland, right? I'm Irish, so I would say this, but I grew up in Ireland when it was in permanent recession through the 70s and 80s. And there was one good year. I remember my dad told me, I think it was 1978. And I left in 1989 and thought it was a basket case. There was really nothing to do, and headed off to the bright lights of London. And it shows you my ability to forecast, right? So I missed the 20-year boom. But, what Ireland did, the politicians created an attractive platform for people to invest. There was an investment in educating the workforce, creating the skills and the expertise, and then selling that to the world. And they did a bloody good job at selling it. And they attracted a huge inward investment. Now, the fact that the economy got way overheated is sort of by the by a little bit. I think it's all about the Greek government needs to figure out how to deal with all of the noise from a social perspective, that's obvious, with making Greece an attractive place to invest.
Okay. Well, we've run out of time. I think we've covered a hell of a lot of ground. Everything from prospects for the investment market, which seem, in comparison with some other asset classes, pretty healthy. A flat development and leasing market, still not much money around for new development. Having said that, some really interesting trends going on in terms of the internet. I think Amazon itself is fascinating. Mergers and acquisitions around the whole sector. And then a trot round the different hotspots and not spots, if you like. And finally, a good insight into the future of Prologis. So one other thing I have to say is that there are, I think, what's called link-up sessions for some of the audience to meet the panellists straight afterwards. That's a reminder, if you've been asked to those, to go along, and the organisers can help you with that. A couple of points for me. You can see editions of Property Week on the stands at the bottom of the stairs there, including a big Sheds supplement we have. And very last thing, of course, is to say please give our panel a round of applause. Thank you very much.